When most of us think about the AI boom, I mean, we picture something that feels almost like magic.
Right, yeah. Like, it just happens.
Exactly. You type a prompt into a box, and instantly a fully formed essay or like a piece of art or complex schedule just appears.
It's seamless. It feels like this invisible, weightless software just living up in the cloud somewhere.
It really does.
Yeah.
But the bottleneck for all this magical AI isn't the software anymore. It's actually, well, it's the physical laws of moving electrons around.
Oh, yeah. The physical reality is brutal.
Yeah, inside these incredibly heavy, incredibly hot physical warehouses that are just packed with servers humming at maximum capacity.
Mm,
I mean, we are constantly trying to push oceans of data through an infrastructure that was never designed for this much pressure.
that's the perfect way to put it, yeah.
Okay, let's unpack this because our mission today
Yeah.
in this deep dive is to cut through the dense, financial jargon of Rambus Inc.'s first quarter 2026 earnings report.
And there is a lot of jargon in there.
Oh, ton of it. But we want to find the aha moments about the hidden infrastructure of this whole AI revolution. We're breaking down how a company that operates entirely behind the scenes, making data move faster and safer at the microscopic level, it's just quietly dominating.
Yeah, the contrast between, the consumer perception of AI and the physical reality is really stark. Rambus is operating entirely in the trenches of that physical reality.
Right.
I mean, we are looking at a company delivering $88 million in product revenue for Q1.
Wow. 88 million
Yeah,
just in physical products.
exactly, which is a 15% increase year over year.
Yeah.
And, that kind of jump in physical tech hardware doesn't just happen by accident.
No, it takes massive demand.
Yeah, and CEO Luke Serafin points directly to the data center as the catalyst for this. But more specifically, he attributes this jump to the rise of AI inference and what he calls agentic workloads.
Agentic workloads. Let's talk about that because that represents a fundamental shift in computing architecture, right?
It really does.
Because for a long time, the standard AI interaction was just a simple call and response. You ask a question, the model processes it, and it gives you an answer.
Right, a single transaction.
Yeah, and that requires a certain amount of memory bandwidth, sure. But an agentic workload is like a continuous autonomous loop. You give the AI a high-level goal, and it breaks that goal down itself.
It figures out the steps.
Exactly. It queries a database, it analyzes the result, then it realizes it needs more context, so it writes a script, executes that script, and evaluates its own output.
And all of that is happening constantly.
Constantly. It is shuffling mind-boggling amounts of data back and forth between the processor and the memory, like continuously, in fractions of a microsecond.
What's fascinating here is how that constant shuffling exposes the limitations of our current hardware. I mean, in computer science, this is often tied to the von Neumann bottleneck.
Okay, the von Neumann bottleneck. Remind us what that is.
So processors have become, exponentially faster at calculating over the years, but they spend an agonizing amount of time just sitting idle, waiting for data to be retrieved from memory.
So the brain is fast, but it's waiting on the filing cabinet to open.
That's exactly it. And to run these multi-step agentic workloads without the whole system just grinding to a halt, data centers require massive, unprecedented memory bandwidth.
Because if the processor waits, the system lags.
Right. And if it lags, the economic value of that incredibly expensive AI hardware just plummets. So Rambus designs the critical chips and the silicon IP that physically widen those data pathways.
I was looking at the specific technical achievements driving this 15% revenue bump, and it made me think of a physical engine.
Okay, how so?
Well, if AI is this massive, incredibly thirsty V12 engine in a race car, Rambus isn't really trying to build the engine itself.
Right, they are making the main processor.
No, because every major tech giant on Earth is already fighting a complete bloodbath over who builds the best AI processor. So Rambus is like designing the highly specialized ultra-wide fuel lines that stop that processor from choking.
Oh, I like that analogy.
Yeah, because if your fuel lines are too narrow or if the fuel injection timing is off by even a millisecond, it doesn't matter how massive your engine is, it will stall.
Rambus is building the infrastructure that feeds the beast.
They absolutely are. And their recent catalog of releases shows they are engineering these solutions across multiple different stress points in the server architecture.
Like where? What are they focusing on?
Well, the earnings presentation highlights their strong execution across their DDR5 chip solutions, which basically manage the primary system memory.
Okay.
But they are aggressively expanding into next-generation bottlenecks, too. They rolled out the LPDDR5X OSOCAM M2 server module chipset.
That is a mouthful. What does the LP stand for?
Yeah, it's a lot of letters.
Yeah.
The LP stands for low power. It brings mobile-style power efficiency into the enterprise server space. Oh, wow. Which is a huge deal, right? Since data centers are already pushing the absolute limits of the local electrical grid.
Exactly. Power efficiency is becoming just as important as speed.
They also highlight a network security engine that's specifically designed for Ultra Ethernet. And that caught my attention because, well, security is usually thought of as a software layer.
Traditionally, yes.
But when an AI agent is like autonomously pulling data from proprietary corporate databases to execute a task, you really cannot afford the latency of running that data through a clunky software firewall.
You lose all your speed.
Right. So
Wow.
Rambus is embedding the security protocols directly into the silicon architecture of the network itself.
Which is brilliant.
Yeah, you encrypt and decrypt at the hardware level, so you maintain the speed while locking down the data.
That physical integration is really the only way to meet the latency requirements of modern AI. But, perhaps the most critical piece of architecture mentioned in their release is their HBM4E memory controller IP.
Let's talk about HBM, high bandwidth memory.
Yeah, HBM solves the physical distance problem by literally stacking memory chips on top of each other, like pancakes,
Oh.
and then placing them right next to the processor.
Which is insane engineering.
It is. It's the absolute lifeblood of the most advanced AI accelerators today. And Rambus proudly notes their HBM4E controller is the industry's fastest.
And what does the controller actually do in that stack?
The controller is like the logistics manager. It dictates the timing, the voltage, and the precise routing of data into those stacked chips. So holding the IP for the fastest controller in the industry puts them in an incredibly powerful position.
Here's where it gets really interesting, though, because, having the fastest tech in a laboratory setting doesn't automatically mean you have a viable business.
Far from it.
Right. The graveyard of Silicon Valley is overflowing with brilliant engineers who built, incredible hardware but couldn't figure out how to monetize it without burning through venture capital.
Oh, yeah, the classic cash burn.
We are so conditioned by that classic tech narrative, right? Companies subsidizing growth, running at massive losses for a decade, just constantly diluting their stock to raise more capital.
Exactly.
So when we look at Rambus's balance sheet, are they actually capturing the financial upside of this AI boom? Or are these top-line revenue numbers just masking a massive cash burn behind the scenes?
The financial scorecard for Q1 answers that definitively. This company is a highly profitable, cash-generating machine.
Okay, lay the numbers on us.
Total Q1 revenue hit $180.2 million, which actually beat the midpoint of their own guidance.
Wow.
But the true strength lies in the architecture of that revenue. We talked about the $88 million in physical product revenue selling the actual memory interface chips.
Right, the fuel lines.
Yeah. But the remaining revenue reveals a highly diversified model. They pulled in $70.8 million in licensing billings, plus $69.6 million in royalty revenue, and another $22.6 million in contract and other revenue.
Let's break down the mechanics of that licensing and royalty revenue because, honestly, it is the secret weapon of the semiconductor IP business.
It really is.
They aren't just stamping out physical chips in a fab and hoping someone buys them. With IP licensing, Rambus spends the intense R&D to figure out how to perfectly optimize that HBM4E memory controller we just talked about.
They do the hard math.
Right. They patent the architecture. Then they turn around and license those blueprints to other major chip makers.
Yeah, the other companies do the heavy lifting of manufacturing.
Exactly. But Rambus gets paid upfront for the license, and then they collect a royalty for every single chip that utilizes their design rolling off the assembly line.
It is the ultimate high-gen business model. You amortize your research costs across the entire industry's manufacturing base. And that structural advantage flows directly into their cash generation.
Which was huge this quarter, right?
Massive. For the first quarter, their cash from operations was an astounding $83.2 million.
Just from operations.
Yes. The day-to-day mechanics of running this business generated over $83 million in surplus cash in just 90 days.
That is wild, and that operational efficiency really creates a compounding advantage. Like looking at their balance sheet, their total cash and marketable securities now sit at $786.1 million.
Almost $800 million just sitting there.
Yeah, they added $24.3 million to their war chest just since the end of 2025. We are looking at a company with total assets equaling $1.533 billion.
It's a very healthy sheet.
Very healthy.
Yeah.
But out of all the metrics in this earnings release, the one that fundamentally changes their strategic posture is this. The company carries absolutely zero debt.
Zero. If we connect this to the bigger picture, operating debt-free in the 2026 macroeconomic environment is a formidable weapon.
Because debt is expensive right now.
Extremely. Developing next-generation silicon is notoriously expensive. Tape-outs for new chip designs can cost tens of millions of dollars before a single product is ever sold.
And most hardware companies just borrow to cover that.
Exactly. They rely on debt to bridge that gap. But when interest rates are elevated, the cost of servicing that debt aggressively eats into profit margins, and it forces companies to scale back their R&D.
Which hurts them in the long run.
Right. But because Rambus throws off $83 million in cash every quarter and has literally no debt payments, they can internally fund their entire strategic roadmap. They dictate their own pace of innovation without having to answer to bondholders.
That kind of financial independence is just rare. But, to really understand how they evaluate their own financial health, we have to navigate the dual reporting structures in this earnings release.
Ah, yes, the accounting side of things.
Because they provide both GAAP numbers and non-GAAP numbers. So GAAP net income was reported at $59.9 million, which translates to 55 cents per diluted share. However, their non-GAAP net income jumps up to $69.3 million, or 63 cents per share. There's nearly a $10 million difference in the bottom line, depending on which lens you look through.
We see that exact same divergence in their cost reporting, too. GAAP total operating costs and expenses were $118.4 million, but non-GAAP costs dropped down to $100.6 million.
So why do companies do this? Are they just trying to hide messy expenses from investors?
No, it's actually about clarity. GAAP, which stands for Generally Accepted Accounting Principles, is rigid. It forces every publicly traded company to account for every transaction using a universal set of rules.
Which is necessary for a baseline comparison across different companies?
Exactly. But GAAP often forces a company to record non-cash expenses, or like one-time anomalies that distort the actual repeatable cash-generating power of the core business. Rambus uses non-GAAP metrics to basically filter out that noise.
So management and investors can see how the memory architecture business is actually performing day to day.
Exactly. It's translating, not hiding.
Let's look at the specific filters they applied to get from the $118 million GAAP costs down to the $104 million non-GAAP costs.
Sure.
The largest adjustment by far is the removal of $11.45 million in stock-based compensation.
Right. Because in the highly competitive semiconductor industry, you just have to pay your top engineers in stock to retain them.
Yeah, otherwise they go to a rival,
Mm-hmm.
and GAAP requires that stock issuance to be recorded as an expense against profits because it dilutes the existing shareholders.
Which is absolutely a real cost to the investor's equity. I mean, we shouldn't ignore it, but it is a non-cash expense.
Right. Rambus didn't write an $11 million check out of their operating cash to cover it.
No. So if your primary goal as an analyst is to figure out exactly how much free cash flow the business generated this quarter, to fund the next cycle of HBM development, leaving that non-cash expense in the calculation just muddies the waters.
That makes sense. The other adjustments provide a window into how they are managing their physical footprint and historical acquisitions.
Yeah, they stripped out $1.67 million in amortization of acquired intangible assets.
Okay, so when Rambus buys a smaller tech firm for its patents or client lists, GAAP mandates they slowly expense the value of those intangibles over several years.
Right. It's an accounting mechanism tied to a past strategic move. It's not cash leaving the building today.
But the adjustment that really illustrates the utility of non-GAAP is the $730,000 they removed for facility closure costs.
That's a perfect example. The earnings release explicitly ties that $730,000 to the abandonment of a building lease during the first quarter.
It's just a broken lease.
Yeah, it includes the remaining lease expense, the cost to restore the building to its original condition, and relocation logistics.
That is the perfect example of accounting noise. Shrinking their real estate footprint is a one-time event. If you leave that nearly $1 million charge in the operating expenses, someone just glancing at the quarter-over-quarter numbers might conclude that the core business of engineering memory controllers is suddenly becoming less efficient.
When in reality, it has nothing to do with the controllers.
Exactly. By filtering out that exit fee, Rambus provides a clearer baseline of their day-to-day operational run rate. They also apply a flat 16% tax rate across all their non-GAAP calculations to strip out the volatility of one-time tax credits or valuation allowances.
Which creates a smooth line for internal forecasting. And understanding that clean baseline run rate is essential because it sets the stage for their forward-looking
Right,
projections.
looking to the future.
Yeah. With a fortress balance sheet and a really clear view of their core profitability, the earnings presentation pivots to their Q2 2026 outlook, and they are projecting sustained momentum in the very hardware that feeds these AI systems.
The Q2 outlook points toward continued expansion, specifically in their product revenue. Like after hitting $88 million in Q1, they expect Q2 product revenue to accelerate, projecting a range between $95 million and $101 million.
That's a solid jump.
Yeah. That suggests they anticipate the physical deployment of AI infrastructure, like actually installing these memory interface chips into new data center builds, to ramp up significantly in the coming months.
And at the same time, their IP licensing and royalty segments are projected to remain remarkably stable, which really reinforces the value of that diversified model we talked about.
What are the numbers there?
They expect Q2 licensing billings to land between $76 million and $82 million. Royalty revenue is projected between $72 million and $78 million, and contract and other revenue between $19 million and $25 million.
Okay, so steady cash flows there. But to fuel that expected product revenue growth, they're projecting a slight increase in operating costs, right?
Yeah, a bit of a bump.
Q2 total operating costs are expected to fall between $131 million and $127 million on a GAAP basis, or $114 million to $110 million non-GAAP. They are clearly deploying some of that massive cash generation to scale their operations alongside the demand.
They are. But this raises an important question, however. A Q2 outlook is a projection based on current market dynamics. It's not a guaranteed contract.
Right, things can change.
The enterprise hardware sales cycle is notoriously complex. To hit that 95 to 101 million product revenue target, Rambus has to actively execute.
So they can't just rest on their laurels.
No. Having the fastest HBM4E controller on the market gives them a massive advantage, obviously, but they still have to navigate the procurement cycles of the major cloud service providers and server manufacturers.
You have to close the deals.
Exactly. They have to sign the customer agreements and finalize the solutions licensing in a space where, honestly, delays in server rack deployment can instantly push revenue from one quarter to the next.
So what does this all mean? When we aggregate all these data points, the $88 million in product revenue, the $83 million in operating cash flow, the expansion of the LPDDR5X and Ultra Ethernet lines, what is the overarching narrative of Rambus right now?
It's a story of focus.
To me, it signals a company that is aggressively reinvesting its current dominance into a long-term strategic roadmap. I mean, they aren't hoarding that $786 million war chest out of fear.
Right.
They are using their financial independence to ensure they remain the critical bottleneck solvers for the next decade of AI architecture. They're already engineering the solutions for the engines that haven't even been built yet.
Because they recognize that the constraints of physical infrastructure are the true governors of AI advancement. I mean, you can write the most elegant, sophisticated agentic software model in the world, but if it takes too long to pull the necessary data from the server's memory banks, the model fails commercially.
It's useless.
Right. Rambus is positioned at the exact intersection of logical ambition and physical limitation.
Which brings us to the core takeaway for you, our listener, today. Rambus represents a masterclass in capitalizing on the unglamorous, inescapable physical realities of the technology sector.
Well said.
While the mainstream conversation fixates on consumer chatbots and, software capabilities, this company is operating a debt-free, highly profitable enterprise by ensuring those software models actually have the physical data pathways to function. They are the underlying cardiovascular system of the modern AI data center.
And their combination of physical chip sales with high-margin IP licensing creates a business model that scales beautifully with the broader industry's growth.
All while insulating them from the direct, highly volatile competition over processor manufacturing.
Exactly. Let the tech giants fight over the processors. Rambus will just sell them the fuel lines.
But I want to leave you with a final thought to mull over, extending beyond the Q1 numbers we've discussed today. The Rambus earnings release specifically cites the growth of agentic workloads as a primary driver. Right now, Rambus holds the industry's fastest memory controllers just to prevent the system from choking on today's AI demands. But extrapolate that out. What happens in the near future when it isn't just human users occasionally prompting an AI, but billions of autonomous AI agents interacting with each other continuously?
I mean, picture a world where your personal AI assistant is autonomously negotiating with a travel AI, which is simultaneously querying a banking AI, executing millions of microtransactions a second.
This scale is unimaginable.
The data throughput won't just double. The demand on memory architecture will grow exponentially.
Exactly. And it forces us to ask what fundamental ground-up shifts in computer architecture will be required to handle that reality. Because eventually, simply widening the data pathways with faster memory controllers might hit the absolute physical limits of silicon physics.
You might just hit a wall.
Yeah. The entire paradigm of how processors and memory interact may have to be redesigned from scratch. And you can guarantee that the engineers sitting on nearly $800 million in cash at Rambus are already trying to figure out what that new paradigm looks like.
Oh, without a doubt.
Thank you for joining us for this deep dive into the hidden hardware powering the AI boom. Keep an eye on the infrastructure, and we'll see you next time.